So let's talk a little bit about assessing risk. So we're going to talk about trading style. We have to know what we're willing to risk. That, in my opinion, is the most important step. Knowing and understanding that the market dictates risk. The market doesn't care how much we're willing to risk or how much we want to avoid loss. It doesn't care. It's going to trade. It's going to go, right? So market dictates how much risk there is and how much risk we should be taking. And then the position size. So when we're assessing a risk, the first thing that we have to ask ourselves is, what is our trading style? And we'll go over some of those different trading styles here in a moment, just to kind of give ourselves some guidelines. But what this really comes down to is, am I somebody that has the time to be a day trader, so to speak, where I'm going to sit, I'm going to trade, let's say a 5-minute chart, and I'm going to take, 20 or 30 trades a day. Can I sit in front of the computer, be glued to the screen all day long during active market hours? If the answer is yes, then great. But there are some of us, and I think I actually saw some names in the room that I recognize that I've worked with before that can't sit in front of the screen all day, and they might have blocks of time that they can trade, and so they might have to have more of an approach that is a day trade, or not a day trading, but more of like a swing trading style, where they assess the market in the morning or in the afternoon or whatever it might be, place their trades and hold risk overnight for days or even weeks at a time. So we have to decide, what kind of time frame or uh, how much time do we have to trade, right? How much time can we commit to sitting in front of the charts and sitting in front of the screen? How active can we realistically be? You know, uh, that's a very key. Some of us have full-time jobs aside from our trading careers, and that's fine. But that means that we can't necessarily be somebody that trades a 5-minute chart all the time. And then most importantly, and this is why I have it bolded, how much am I realistically willing to risk? So if I have a $25,000 portfolio, I don't want to risk $25,000 per trade. I don't even really want to, at that point, risk $1,000 per trade. I might only be willing to risk $100 per trade or $200 per trade. And so if I'm only willing to risk that amount, that means there are certain bar lengths that I may not be able to trade. And that's exactly what we're going to get into. So that's why it's a key point. I always joke with clients and say, when I'm looking at the amount of risk that I want to take per trade, it has to be that threshold where if I lose that amount in that day, my wife is still going to let me sleep in the bed that night. Because if she's not going to let me sleep in the bed, if I'm going to have to sleep in the couch or outside with the dogs, then that's too much risk. So that's something we have to ask ourselves. Where is that threshold? What are we willing to risk, and we can still move on? It's not going to be disastrous. And that's our risk threshold. We also have to look at what types of markets do we want to trade. Are we trading equities? Are we trading commodities, foreign exchange? Because there's different things that go along with that as well, as far as position sizing, leverage, and so on. Can we trade various markets? There's some of us, like Miss Case talks about this all the time. When she was an oil trader for Chevron back in the 80s, she could only trade certain markets, basically oil, heating oil, crude oil, and she didn't have the luxury of going out and saying, well, I want to trade natural gas today, or I want to trade, the S&P 500, or some equity market or whatever else. She couldn't pick and choose. So if you're in that situation, there are going to be times where you might have to sit on your hands and step away from the market because there is too much risk involved, because the volatility is too high or whatever it may be, or maybe we're in a sideways market. And that comes down to, when is a market untradeable? There are periods of time where it may be in a sideways range, or very, volatility is too high, and you have to take a step back and take a deep breath and wait for good opportunities. And the last point here is, using a stop is a must in our opinion. We have very sophisticated stop systems that we've developed over the years, and that's a large part of what I'm going to be showing you on how to assess risk and how to determine the bar size that is most effective for your trading style and your risk appetite.